Okay, so in fiscal year 18, we have 4 GASB pronouncements. So the first one is GASB 75, which is accounting and financial reporting for post-employment benefits other than pensions. And I know this is one that you guys are all really interested in. So we have actually 2 classes this afternoon that will go into the details of it. And Mary Beth Redding will also be here to talk about it. So I'm not going to go into it in this class, but just stay tuned after lunch. And then we have GASB 81, which is irrevocable split interest agreements. And then GASB 85, which is Omnibus 2017. And GASB 86, which is certain debt extinguishment issues. So 4 of them in fiscal year ending June 30, 2018. Okay, and then in fiscal year ending June 30, 2019, we have 2 GASBs. The first one is GASB 83, which is certain asset retirement obligations, and then GASB 88, which is certain disclosures related to debt, including direct borrowings and direct placements. And this one was actually just issued in April of 2018, so you might not have heard about it as much as the other ones. And then in fiscal year ending June 30, 2020 and June 30, 2021, each of those years has 1 GASB. So the first one is GASB 84, which is fiduciary activities. And this one is effective in fiscal year ending June 30, 2020. And then GASB 87, which is the best one of them all, is effective in fiscal year ending June 30, 2021, and that's leases. All right, so let's get started. Well, actually, before I go further, for those of you who have December 31st fiscal year ends, this slide is just kind of designed for you to figure out which GASBs are to be implemented by fiscal year end date. So kind of informational there. Oh, wait, right here. Okay, so the first one, effective in fiscal year ending June 30, 2018, is GASB 81, which is irrevocable split interest agreements. So these agreements are actually a specific type of giving arrangement used by donors to provide resources to 2 or more beneficiaries, one of them being another government entity. And basically that intermediary, as part of that agreement, just administers the resources of pursuant to the agreement to, make sure that it gets to the beneficiaries pursuant to that. And GASB has defined that intermediary as a trustee, a fiscal agent, or any other government or legal or natural person who's holding and administering those benefits to be provided to the beneficiaries pursuant to the agreement. And just as an FYI, a lot of these are uncommon for cities and special districts, where they're most common that GASB has found is like school districts and education foundations or hospitals, because a lot of times they get, donated, trust funds or trust money from trusts and stuff like that. So a typical irrevocable split interest agreement has 2 components. A lead interest is one where payments are being made throughout the life of an agreement to the beneficiaries. And then there is also a remainder interest type of agreement where the payment to the beneficiaries happens at termination of the split interest agreement. So basically, these agreements terminate after a specified period of time. And then some examples that GASB has provided of these types of giving arrangements are a charitable lead trust, which is where payments are being made throughout the life of an agreement. These are typically being made to a non-government beneficiary. So you, as a local government, you probably won't have these types of arrangements. But the next one would be more common, which is a charitable remainder trust, where at termination of the split interest agreement, the assets will go to the local government. And then there is a life interest in real estate, where real estate is given to the government upon death of the donor or termination of the agreement. So overall, it's, the agreements have to kind of terminate at a specified period of time. And so that's how you would figure out which type of arrangement it is. Okay, so really what it boils down to in this GASB is who is the intermediary pursuant to the split interest agreement. So Here's the example of where the government is acting as that intermediary. So they are holding the assets pursuant to the agreement and then making sure that those assets are getting dispersed accordingly pursuant to the agreement. So if this is the case for the local government, for a lead trust and a remainder trust type of arrangement, the government will book an asset for the amount received or the receivable, and then a deferred inflow for the government's unconditional lead interest, and then a liability for any of the interest remaining to be assigned to other beneficiaries, or that is assigned. And that's because, they're holding it, the local government's holding it, but it hasn't been dispersed yet to the beneficiaries. And then for a life interest in real estate, the government will book a capital asset or an investment, and then a liability for estimated expenses like insurance or maintenance on that real estate. And then a deferred inflow, everyone's favorite. I know we can't get away from deferred inflows, but you will also book one of those for the difference between those two. And then once that agreement has terminated and those assets have been dispersed to the beneficiaries, all of those balance sheet items will be taken off the books because the agreement has ended, everyone's gotten their donation, and we're good to go. Okay, so the next example is where a third party is acting as that intermediary. So the government is not, they're just, expected to get, some donated money or real estate. So in this case, there's certain criteria that must be met in order for the government to book an asset. So that agreement has to be irrevocable, and the government has to be specifically named as part of the agreement. And then no power can be given to that intermediary, and the donor cannot control the intermediary. So as long as those criteria are met, the government can book the asset for that split interest benefit. And that amount is going to be the fair market value each fiscal year. And then if there's any change in that fair market value, it'll be booked through deferred inflows. So, and then in terms of revenue recognition, for a lead interest type of arrangement, so that's where payments are being made throughout the fiscal year, revenue will be recognized as they're given to the local government. And then for a remainder interest, the revenue will be recognized once that agreement has terminated and the asset has been dispersed accordingly. So that's pretty much it for GASB 81. Okay, so the next one, effective in fiscal year ending June 30, 2018, is GASB 85, which is Omnibus 2017. And this is really a hodgepodge of clarifications to previous GASBs that, that subsequently they realized there's some confusion on it, so they need to clarify it. So this first one is the merging of component units. And some users were confused on component units, and specifically for primary governments that are business type activities. So like enterprise types of governments, like water districts or sanitation districts. So for those local governments, and they usually have one column of for financial statement presentation, and all of the activities of that entity are lumped into that single column. Well, GASB has said that you can only do that if all of those activities meet the blending component unit requirements under GASB 14. So you kind of have to walk that path to make sure that those activities do qualify as a blended component unit in order to be in that column. And then the next one is goodwill and negative goodwill. So if you remember, under GASB 69, the requirement was to record excess consideration paid in an acquisition as a deferred outflow, as opposed to goodwill. And some users were confused about whether goodwill should be reclassed as deferred outflow if it existed as of the effective date under that GASB. And GASB has stated, yes, goodwill should no longer exist on the balance sheet. It should be a deferred outflow. And on the flip side, if there is any negative goodwill, it should be reclassed or restated against beginning net position and be eliminated completely. So there shouldn't be any negative goodwill. So, and then, I don't know if there's any insurance entities out in this room. I know we have a few, but clients that are, but if you are an insurance entity, this next one has to do with real estate held by insurance entities. And basically what GASB has said is that that real estate should be classified as an investment or capital asset, depending on what it's being used for. So if it's, being used for something, if it's going to be just held for future sale or something like that, you would probably treat it as more of an investment as opposed to a capital asset. But you kind of have to make that determination for if you're an insurance entity. But I don't think there's any in this room, so if you ever go to one, there you go. Then we have investments in money market funds. So if some of you remember with GASB 72, that fair value hierarchy footnote that has all the levels. So for money market funds at amortized cost, GASB has kind of clarified this fair value measurement by stating that the money market funds can only be shown at amortized cost as long as the issuer's credit rating doesn't significantly change the value of the money market funds. So that's something that has to be determined on, client by client basis. But you just want to, ask your custodian maybe to provide some sort of substantiation of what it should be, whether it should be in one of those levels or at amortized cost. Okay, so then the rest of this GASB is fun because it's all about pension and OPEB clarifications. So basically there was some confusion from users about the timing of defined benefit post-employment liabilities for entities, using the modified accrual basis for financial reporting. And basically GASB has come up with kind of a rule for this by stating that those expenditures and liabilities that are reported in those types of funds have to be those as of the reporting year as opposed to the measurement year. Because sometimes, the measurement year is a year prior. So they're just saying that, that's more consistent with a current measurement focus. So that's what should be used in those financial statements. And then if anyone has on-behalf payments or makes on-behalf payments, these are where an entity is making contributions for pension or OPEB on behalf of a previous employee, perhaps. So they're giving the money to a different entity where that employee that used to work for them used to work or went to go work. So they left the current employer, went to a new one, and that old employer is paying for that employee's pension or OPEB. It's really rare, but if you guys have that situation, GASB has clarified that those amounts have to be recognized as expenditures and revenue. So if you're the one making them, then you would record it as expenditure. And if you're getting them on behalf of an employee from another entity, you have to record it as revenue. So yeah, that's pretty much it for this one. And then the rest of it is more OPEB and pension stuff. So does anyone in this room have or use the alternative measurement method for OPEB? So that would be like where you're not using an actuary. Okay, yeah, you are, okay. So basically this GASB has clarified the assumptions that can be used as part of that method. And it specifically states that the expected point in time at which an active service member will exit from services, that can be used as part of that. And if it is, that it has to be based on past experience and then future expectations. So it's just kind of clarifying that part. And then also it addresses turnover, so that can be used in that method. And that can be applied to determine the assumed probability that a current active service member will remain employed at your entity up until the point which they're eligible to start receiving benefits for the plan. And then the last parts have to do with those required supplementary information schedules in the back of your reports that are getting larger and larger each year. And this is kind of a fixing of GASB 68, 74, and 75 related to those payroll-related measures in those schedules. And most of this was fixed with GASB 82 in fiscal year 17, but this omnibus is kind of clarifying it even further to include OPEB for GASB 75. So for those local governments that have single employer and cost-sharing OPEB plans, the payroll figure should either be covered payroll or nothing based on the contributions that are being made. So if those contributions to the OPEB plan are a flat amount, which is the most common scenario, then it would be, you wouldn't show covered payroll, you would show nothing because those contributions are not based on the employee's pay. But if they are based on the employee's pay, you have to show covered payroll. So it just kind of clarifies those for that type of plan. And then those OPEB plans that are administered through trusts should show covered payroll or covered employee payroll, again, based on whether those contributions are, a fixed amount. So in that case, it would be covered employee payroll. But if they're based on their pay, it should be covered payroll in that schedule. So it's kind of a lot to just remember, but hopefully the slides will help as you're getting closer to, doing your reports. And then we have the last part is employer contributions being made on behalf of an employee. So if you are a local government making payments on behalf of one of your employees for their pension or OPEB plan, well, this is actually specific to GASB 75, so it'd be OPEB. But if that's the case, those amounts should be classified as employee contributions. So even though you're making them, they're still, for the employee, so they should be considered employee contributions, not employer. So that's kind of the clarification with this one. Okay, so we're moving on to the last one in fiscal year ending June 30, 2018. And this one is GASB 86, certain debt extinguishment issues. And this GASB is basically establishing standards for in-substance defeasance transactions where cash and other monetary assets, so all that cash you have, laying around, is being used to defease or extinguish debt, outstanding debt. So some of the guidance they've established is that that money has to be placed in an irrevocable trust, and the amount in that trust has to be used to satisfy scheduled interest and principal payments, so it has to be exact. And it also has to be consisted of assets that are very risk-free, so like US government obligations, for example. And the reason for this is that they want to make sure that there's, risk-free assets set aside in that trust that can pay that outstanding debt. And then also, this part I thought was pretty interesting, is that that money has to be denominated in the currency that the debt was issued in. So if you used US dollars to issue the debt, the money in the trust has to be US dollars. So you can't go around using that euro or something in there. And then if there's prepaid insurance used to extinguish the debt, that has to be used in recalculating the reacquisition price for the extinguished debt. And then, of course, all of this information will be in your footnote disclosures. So that, again, is really just disclosure. There's not going to be any accounting treatment for that. Okay, so we're moving on to fiscal year ending June 30, 2019. So the first one that fiscal year is GASB 83, which is certain asset retirement obligations. And you might hear the acronym ARO, which GASB has kind of coined as part of this. And these basically result from the normal operations of tangible capital assets, whether they have been acquired or constructed. And it includes the liabilities associated with retiring those assets or disposing of them. And their thought behind this one is they still have GASB 18, which is for landfills, and that this is not replacing GASB 18. The landfills GASB will still be applicable. This is just providing some guidance on the other types of assets that most of the time have liabilities associated with retiring them. So that's kind of the thought behind that. So some examples of these types of obligations are nuclear power plants, which I don't think anyone has in this room, but if you do, that's pretty interesting. And then sewer treatment plants, and then removal and disposal of wind turbines and X-ray machines. Those are just some of them. And basically, this GASB is requiring a liability to be booked if there's any legal responsibility to dispose of an asset in a certain way. And it can also include the disposal of a replaced part, so it doesn't have to be the entire asset, it can just be part of it. And it can also include environmental remediation associated with retiring that asset. Okay, so you might be asking yourself now, okay, what am I gonna record? So once you have sufficient knowledge to, book an obligation for this, so that would be like, any letter from a governmental agency or legal action or by law. Once you have information that, you think is gonna require liability to be booked for this asset, you're going to recognize it. So the kind of treatment for it will be, you're gonna have the liability, and then it's gonna be offset with a deferred outflow, and those will equal one another once you have recognized it, that you're gonna have, cash outlays in the future to retire it. And then subsequent to that initial measurement year, the government is gonna have to kind of adjust the current value on an ongoing basis, because a lot of times these assets have changes in the expected future outlays, just with time. And so that's just kind of something that's a little unique about this one. And then the disclosure is gonna include the description of the obligation. It's gonna include the date of the valuation for that liability, and then the expected future costs associated with retiring it or disposing of it. So does anyone have any questions on that one? That one's probably, yeah.
So is it tied to some kind of legal obligation?
Yeah.
So like a water tank that the town, city owns, would that be something that would apply?
Yeah, so the question was, is it tied to a legal obligation or of some sort? So yes, so you would only recognize it if there's something from a third party, probably a regulatory agency most likely, or a contract, it can include that, where they have said, okay, the local government is gonna have to spend, several $1 million or whatever the amount is to, dispose of this asset. But the thing is that materiality does come into play. So if it's not significant, then you wouldn't have to recognize it under this requirement. But, if it's something major where you're like, okay, this government agency has told me that I have to dispose of it or retire it a certain way, then you would probably want to include it in your disclosure and account for it that way. Cool? All right. Okay, so the next one, effective in fiscal year ending June 30, 2019, is GASB 88. And this is certain disclosures related to debt, including direct borrowings and direct placements. And this GASB was the one that was just issued in April of 2018. And it was basically designed to enhance your debt-related disclosures, specifically related to direct borrowings and direct placements, because these kind of expose the government to a unique set of risks. So they kind of want to bring those up to the reader a little bit more with this GASB. And it kind of clarifies which liabilities government should include in their note disclosures. And some of those extra disclosures include unused lines of credit, assets pledged as collateral for the debt, terms specified in debt agreements related to default, and termination events and acceleration clauses. So this one is just disclosure. There's no, a separate accounting for it. But it is something that you might want to look out for if you have these types of direct borrowings or direct placements for debt. Okay, so this next one is GASB 84, fiduciary activities. And the thought behind this GASB is to just kind of provide guidance on reporting fiduciary activities. So they have established some criteria for reporting these types of activities. And the first one is, the government has to control the asset of the fiduciary. And then the government has to have the ability to control providing the benefits to the recipients of that fiduciary. So once the local government has established that these criteria are met for something, then you must report it as a fiduciary fund. And they also name 4 specific types of these fiduciary funds. So there are pension trust funds, investment trust funds, private purpose trust funds, and custodial funds. So once you've identified that a fiduciary activity exists, you would then further clarify, okay, which one of these funds should it be? And that's in fiscal year ending June 30, 2020. Okay, so we saved the best for last. This one is effective in fiscal year ending June 30, 2021. So other than GASB 75, I think this was probably like the bigger one. As you can tell my voice, I'm way more excited about it than you guys. So basically, under previous guidance for leases, under GASB 15, leases were classified as either operating or capital based on a 4-part test. And what ended up happening is that a lot of these lease transactions were being reported differently than similar non-lease financing transactions. So GASB was like, okay, we need to figure out how we're going to address this, because this is not okay. We need to, report these leases better. So it's basically bringing GASB in line with FASB requirements for reporting leases. And it further defines a lease as a contract that conveys the right to use an asset in an exchange or exchange-like transaction for a period of time, too. So it really has to do with what the contract for the lease is. So once you have a contract, where there's a lease, you'd want to identify, okay, is it an exchange-like transaction, and is it kind of allowing the local government to use it the way they want? And so just to give you some FYIs about the exclusions for this GASB, some exclusions are biological assets, inventory, and contracts under the definition of service concession arrangements, and also the leases of intangible assets. So those items would not apply here, just that's part of the GASB as well. And then that lease agreement that I was talking about earlier, that has to be non-cancelable. So it's, set in stone. So in terms of accounting for this GASB, if you are the lessee, so you are leasing the asset, at commencement of the lease, you will book a lease liability, and that is going to be offset with an intangible lease asset. So those will equal one another at commencement of the lease. And then as those payments are being made on the lease, you are going to reduce that lease liability, you're going to recognize an expense, and then you're going to amortize the lease, that intangible lease, over the shorter of the lease term or the useful life of the underlying asset. And then in terms of disclosure, they're going to be very similar to disclosures that exist under GASB 15 for capital lease obligations. So that won't really change much. It's just going to include all that same information. Okay, then on the flip side, if you are the lessor, so you are letting someone lease your asset, at commencement of the lease, you will book a lease receivable, and that'll be equal to a deferred inflow of resources. And then you're not going to retire that underlying asset. You're going to keep it on the books as you normally would and account for it as you normally would. But then as payments are being made, you're going to recognize interest revenue on the lease receivable. You're going to recognize revenue from the deferred inflows of resources over that lease. And then you're going to continue to depreciate that asset as you normally would. So that part will not change. And then in terms of disclosure, you're going to include the minimum lease revenue and any revenue or payments that you received during the fiscal year. Okay, and then some other considerations that GASB has identified in this GASB 87 is that contracts with multiple components and contract combinations are to be treated as separate leases. So say, for example, if you have a lease that has a provision for the local government to lease 3 police cars and 2 fire trucks. Well, GASB has stated that in those kind of instances, you have to treat each of those leases as separate leases. You can't just lump them into one big one, even though it's one agreement. So that's something that's kind of important to know, because I know a lot of agencies use that kind of method as one major lease agreement. And then we have lease modifications and terminations. They kind of address, specific circumstances like that in this GASB. And also subleases and leaseback transactions are to be treated as separate leases. So kind of the same as the contracts with multiple components. And that's pretty much it. So does anyone have any questions on GASB 87? Yeah.
Is there like materiality levels, we talk about like the popular leases or anything?
Yeah, so I need to speak in this, but, so the question was, does materiality come into play with this GASB? And, specifically, like, for example, if you had a copier machine. So yes, materiality definitely comes into play here. So you just have to kind of see, what is the lease amount? What is like the underlying agreement? Like how much is it for? That stuff. So it would definitely be subject to that materiality.
So if it's too small, forget it, you don't apply it?
Yeah. Mm-hmm. Okay, cool. And that's it. And then if you want any of my cool image sources, you can have this. But that's pretty much it.